Is NVIDIA's massive growth sustainable, or are we looking at the peak of the AI bubble? Welcome to this deep dive where we unpack NVIDIA's jaw-dropping $81 billion quarter, covering the Q1 FY27 earnings breakdown and analyzing the parabolic rise of agentic AI infrastructure. Today, we are completely unpacking the bottom line, which reveals unprecedented revenue and structural margin growth, following where the money flows across platform segments and geographic shifts, examining the cash conversion engine that underpins NVIDIA's financial health and capital returns, and giving you the final verdict with a valuation reality check and an overview of systemic risks. Looking directly at the record-breaking print for Q1 FY27, NVIDIA achieved a staggering $81.6 billion in total revenue, marking a massive 85% increase year-over-year, alongside a non-GAAP EPS of $1.87, which represents a phenomenal 140% growth year-over-year. This spectacular performance is accompanied by a structurally optimized non-GAAP gross margin of 75.0%, all driven by parabolic demand for Blackwell architectures and an accelerating global shift toward agentic AI infrastructure. When we look closer at this structural margin leap, we see that the GAAP gross margin hit 74.9%, which is a massive 14.4-point leap year-over-year, compared to the 60.5% recorded in Q1 FY26. While the non-GAAP gross margin reached 75.0%, the primary catalyst for this expansion was the complete absence of last year's $4.5 billion H20 inventory write-down, combined with underlying strength from continued pricing power across the entire system stack. Unpacking the $58.3 billion in net income reveals some critical details for investors, as the GAAP net income skyrocketed by 211% year-over-year to hit $58.3 billion. But the catch is that this figure includes a massive $15.9 billion pre-tax paper gain on equity holdings. In contrast, the non-GAAP net income stands at $45.5 billion, a 139% increase year-over-year, which represents the normalized operational core that institutions actually watch, especially following a policy shift where $1.9 billion in stock-based compensation is now fully loaded into non-GAAP operating expenses. Looking at the segmentation, the data center has established itself as the dominant engine of the company, commanding a massive 92.2% of total revenue, while edge computing accounts for the remaining 7.8%. Specifically, the data center segment generated $75.2 billion, growing 92% year-over-year, with $37.9 billion coming from hyperscale public clouds, representing 115% year-over-year growth, and $37.4 billion coming from enterprise and sovereign AI factories, which is up 74% year-over-year. Meanwhile, the edge computing segment brought in $6.4 billion, showing a 29% year-over-year increase that was primarily driven by solid demand for Blackwell workstations. This growth is accompanied by a massive shift in the global center of gravity, where the primary growth engine is now the United States, bringing in $63.7 billion, with a 148% year-over-year increase, meaning it now commands 78.1% of the total revenue mix. Taiwan remains a significant hub, contributing $12.0 billion, up 57% year-over-year due to ODM concentration. But on the flip side, regulatory hits have severely impacted the China and Hong Kong market, where revenue plunged 53% year-over-year, down to just $4.5 billion, resulting from zero Hopper data center shipments in Q1 and causing the total international mix to drop precipitously from 42% last year to just 22% this quarter. Financially, NVIDIA has turned into an unprecedented cash machine, taking its $81.6 billion in total top-line revenue and routing it through $50.3 billion of operating cash flow to generate $48.5 billion in pure free cash flow, representing an 85.8% increase year over year. This means NVIDIA successfully converts nearly 60%, or precisely 59.5% of its top-line revenue, straight into free cash flow, made possible by minimal capital expenditures of only $1.8 billion. This cash conversion feeds into a bulletproof balance sheet featuring $50.3 billion in cash and debt securities, alongside $30.2 billion in marketable equities, bringing their total near-cash liquidity to a massive $80.5 billion, against a total debt of only $8.4 billion, making their net debt to EBITDA effectively negative and cementing an elite corporate credit profile.
With this financial strength, NVIDIA is returning capital to shareholders at historical peaks, executing $20.0 billion in total capital returns during Q1 alone, which consists of $19.3 billion in share buybacks and $243 million in dividends. This is supported by a massive 25 times increase to their base quarterly dividend, raising it to 25 cents per share, which puts their annualized capital return velocity on a run rate tracking near $78.2 billion, a number backed by the board's brand new authorization of an $80.0 billion share repurchase plan.
Looking forward, the premium multiple is compressing rapidly as Q2 revenue guidance comes in at a stunning $91.0 billion, which implies an incredible annualized run rate of $364 billion, while locking in a gross margin floor at approximately 75.0%. Because of these targets, elevated trailing price-to-earnings multiples compress quickly, leaving the implied forward price-to-earnings to growth ratio highly attractive when compared to mega-cap tech peers.
To weigh everything objectively, we look at the bull versus bear framework, where the bull catalysts highlight the Vera CPU total addressable market as a brand new $200 billion standalone market, with $20 billion already in line of sight for this year, alongside the parabolic architecture of verarubin, which promises a massive 35 times inference throughput jump in the second half of fiscal year 27. Conversely, the bear systemic risks include the potential for total foreclosure in the China market due to tightening United States export controls, as well as macro limits imposed by global energy grids and data center power availability. Fortunately, an earnings quality audit shows absolutely no red flags, proving that dilution control is well managed because stock-based compensation grew at 30.8%, which is much slower than top-line revenue growth of 85.2%. Furthermore, the earnings reality is perfectly clear because the $50.3 billion in operating cash flow aligns precisely with core earnings, proving cash generation is completely real, all while maintaining absolute accounting purity with clean alternative metrics and zero one-time upward adjustments masking poor operational results.
The ultimate bottom line for investors is that this record $81.6 billion quarter is firmly cemented by unstoppable 75% gross margins and unrivaled cash generation, converting nearly 60% of revenue into free cash flow. This is further protected by a massive capital return program, boasting $118.5 billion in total buyback capacity that acts as a firm valuation floor. While the next-gen Vera CPU architecture perfectly sets up the next leg of parabolic growth into a $200 billion total addressable market. Did we miss anything? Or do you think this growth can continue? Let us know your take on NVIDIA in the comments below. And if you found this NVIDIA's earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.